what we need to be doing is developing a new institution, I like to call that Fed 2, which operates much like the Fed and is an alternative to fiscal policy. So Keynes's remedy for the Great Depression was spend. Replace private investment by government investment. The downside of that is that it increases the government sector and it leads to a situation where the things that are being purchased are things that the government decides that we need, as opposed to the things that we ourselves decide we need. I'd much rather see a remedy in which individuals are given the power to spend. So here's the question: how do you give individuals the power to spend and yet still maintain a stimulus for the economy? The answer is, again, the institution I want to call Fed 2. What would Fed 2 do? Well, it would have much the same role as the Fed, but whereas the Fed buys and sells essentially treasury securities, so that the Fed controls the stock of money in the economy by buying and selling treasury bills. When it buys treasury bills, it pays for them with money and there's more money in the economy. When it sells treasury bills, it brings money into the economy. So think of the Fed as balancing these stocks of money and treasury bills in the economy. Well, wealth consists of a lot more than just money and treasury bills. It consists of stocks, it consists of mortgage-backed securities, it consists of houses, it consists of lots of these things. The Fed has been controlling just one of these margins. What we need to be doing is thinking about more than that margin, about controlling not just the value of money relative to treasury bills, but the value of treasury bills relative to other assets. An example is mortgage-backed securities. The Paulson Plan was one step towards the creation of the institution I'm thinking about. What this institution would do would pick a basket of, let's start with the stock market, I'll come back to mortgages in a second. It would pick something like the S&P 500. It would say, just as the Fed controls the interest rate on overnight loans by saying, we'll borrow and lend this month at 3%, so Fed 2 would say that we're going to control the price of the S&P 500 by buying and selling index securities at price P, whatever the Fed decides it is. If the price falls below that, the Fed would buy these securities on the market. If it goes above that, the Fed would stand ready to sell them or sell securities which were identical. Now, I want to be clear here, I'm not advocating that government step in and buy and sell individual stocks. The markets work very well in allocating individual commodities, deciding how many left and right shoes to produce. I don't want government in there doing that. I'm not advocating socialism. What I'm advocating is a slight extension of the regulatory institutions that we've had since 1913 when the Fed was created. All I'm arguing for is something a little more along the lines of what the Fed's already been doing. In the last 6 months, let me back up, typically the asset portfolio of the Fed consists of 90% treasury securities. In the last 6 months, buying and selling treasury securities wasn't sufficient to prop up the markets. So the Fed started buying other kinds of assets of distressed corporations. That's one step towards what I'm advocating. By going beyond treasury securities and buying other kinds of assets, the Fed can now manage not just one margin, the interest rate margin, but also the relative price of these kinds of securities relative to treasury bills. So the example of having an intervention in, for example, the S&P 500 is an extension of that to a broad index of market securities.